Hi, this is Randy Finney with Right Side of the Chart, and this is an early session update for Monday, May 17th, 2021. And what I'll do in this video is start out with an update on the broad market, the major stock indexes, and then roll into some of the recently highlighted trade ideas, both active swing trades as well as longer term trades, such as gold, things like that. All right, starting out here, let's begin with the 60-minute chart of QQQ. This was the chart posted this morning. These are the two recent bounce target zones. We had this one back here once we got the sell signal. That was the first sell signal early one came on this trendline break, but the big one I was waiting for was a break of 334 right there. The yellow line, we got that there. Kick back to it, gave you an objective shorting up. We had two successful defenses of the next gap support right down there. That was a logical place for the market to bounce, for the buyers to step in. It did. Rallied up to the top of the zone, giving another objective short, or that zone capped it. We also have the potential trend line. I'm just throwing out all these levels to watch because there's a lot of moving parts on the charts, especially these 60-minute charts. So that's downtrend line right there. And then that was a couple weeks ago. More recently, we had that gap support zone, which then became the next bounce target zone once we took it out. And we came back up to it last week right there on Tuesday, rejected another leg down, and then to kind of wrap things up, to summarize, this is where we closed last week. Counter trend bounce and rejected so far at the top of the zone. That's where we closed on Friday. That once again provided an objective short entry. Whether you're an active very active trader, if so, you get about 1.5% drop so far, or a swing trader. These are tactical levels to add on or layer into short, especially if you're again an active trader covering, selling the rips, covering on the rips and selling into covering on the dips. It's like buying the dips in reverse. Sorry, a little tongue-tied there. When you're in an uptrend, you buy the dips and sell the rips. When you're in a downtrend, you do the opposite. It's very simple. You cover the dips and sell the rips. And when I say that, it's not so easy as just selling something because it's up. Again, strategically or more so tactically, entering, closing longs if you took longs on the bounce, and or adding to reversing back into a short position at resistance. So that's where we're at. And today, in this morning's post, I said you'd get the next sell signal, I believe, on a break of this that first candlestick low, which it was 323.41, and we got that so far. So we're back down below there, and I do think this will, this whole thing right here, as little as it is so far, again 1.5% or so, is probably the beginning of the next leg down. Again, if my analysis is right, and if I'm not, that's what stops are for. Never get married to a trade. Determine where you think things are going, and therefore once you have your downside target, you can then place a stop that's in line with that, using an attractive risk reward ratio. What else has happened? So lately we had a 60-minute divergence right there, bullish divergence on the RSI, but not the PPO. And that's all it took last time around, the last correction. But we had dropped 12% on QQQ when we had that RSI divergence the last time around. This was the last correction. I want to show you one more thing before I move on. And this kind of is speaking to those that are a little bit newer to trading, especially active trading, or maybe even investing. And we'll talk about this bounce last week. Let me just flip over to another board here. I already mentioned on Friday that we rallied up to the 38.2 Fibonacci retracement. That's a key, and usually the minimum on a counter trend rally. That's usually the minimum bounce is a 38.2% retracement of the previous move down. That's the previous move down. That's the 38.2 Fibonacci retracement right there. We could certainly bounce more and still say this is just a counter trend rally. Not always, but again, this is just a rough zone. That 38.2 up to the 61.8% retracement level is typical for a counter trend bounce. Now, let's talk about one more thing here. Let's talk about last week, Thursday and Friday. Let's talk about how bullish they might have felt, or especially whether you were long or on the wrong side of the trade. That was a 3.69 or 3.59. We'll call it 3.6% bounce. You can see the pop-up box there on the left. It's down towards the bottom in green, the percentage gain. And so what I like to do when kind of comparing a bounce, and that's what I did this on Friday, but I didn't cover it in the video, and I'll show you right now. I like to draw a line from the lows to the highs, and that tells me two things. Okay, one, the things, consider it like a graph. Back in math, you use these kind of graphs right here, and you have the x-axis down here, and you have the y-axis, up and down. And so what a line, when I take a line from the lows to the highs, it's telling me two things. It's telling me the percentage gain in the y-axis right here, how much we went up, and on that x-axis it's telling me how long the bounce lasted for, because that's time. Remember, this is the date down here. This is a 60-minute chart, so these are your daybreak lines right there, your date lines, and each candle is 60 minutes of trading. So again, you're getting two values from there, and then what I do is I like to compare it to previous corrections, and that's what again I did last week, and it came back that this was just a run-of-the-mill. Let me put it right about where it needs to be. Try to zero it in here. There it is. So this line comes off the lows from last what was it again, Wednesday, up until Friday's high. And you take this line. Here was our last correction, decent tradable correction, swing tradable, 12% drop in QQQ. And so if we roll back to when we were in correction mode or just coming off it, you can see these rips. That one was almost perfect when I put the line there. There's another bounce right there. And again, you're seeing two things. It's coming in right about the same percentage gain, and also the same amount of time that the bounce took. This was one of the bigger counter trend. We had two decent counter trend rallies in that 12% correction right about in the middle, and you can see this one, as far as the time goes, when I put the line right there, exactly the same candle. That peaked out right there on the candle March 2nd, the 10 a.m. candlestick, and then you put it to the bounce before that from the lows to the high right there, same thing, dead on, no variation. It's exactly the same amount of time. Both those bounces were actually just a little bit higher. So again, that just helps to put it in perspective, and that's what these counter trend rallies feel like. Again, assuming this thing could be over. Maybe that was the lows right there. Maybe we go up now. If not, the point I was trying to impress is, in time. In fact, this was the bottom right here. This one was a little higher. So you take that measure on that last bounce, put it there, and what it's giving you is the same exact percentage bounce. So that's it. So these counter trend rallies are about 3.5%, and so that therefore, they might feel bearish, or I'm sorry, feel bullish for those 2 days where it seems the market's going up, 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 up. But again, when you take a step back and look at the bigger picture, and to me, the bigger picture is, you have to pick a team when you're trading. You're either long or short. You're either a bull or bear, or you can be neutral. And I'll tell you, if you don't know, if you're not sure what to do, the best trade is stay on the sidelines. Don't do anything. But if you are going to trade, you have to pick a team if you're going to swing trade, and if you believe that this was the correction, that it's over and we're going to new highs, then you flip back to the buy the dips, pullbacks to support, and that's what I'm doing for you. I always tell you my analysis will prove to be right or wrong, but where you can get some value is these key levels that I'll identify in advance, support and resistance levels, trend lines like that, and then a bull can buy pullbacks to support. So for example, now, if you were bullish and you thought we're going to new highs, I wouldn't buy right now because we just broke that support at the bottom of my bounce target zone, and that to me put us on the next sell signal that's going to take us down to at least 320.83 roughly for a backfill of this gap right here. And again, if you're think we're going lower, then that was your objective time today, just before I started the video, and even right now, to add to, especially if you covered last week, or again, there's a myriad of possibilities of where somebody could have put money in along the way. So I can't just speak to one stop loss that's objective for everybody in one target, because these entry points, again, when I cover these 60-minute charts, lots of entry and exit points, support and resistance levels. And so that's it. Just wanted to mention that so far we are in a downtrend. We have all the makings, a series of lower highs, 1, 2, 3, and lower lows. And where will this, where will we know that we're in a downtrend with probably more downside to come once we take out last week's lows, which are, I think, was that Wednesday I said? Yeah, Wednesday we hit that low right there. And then where will it start to chip away at the bearish case? Well, if we exceed my bounce target zone by, nothing, a slight little pop, that's insignificant. It's a $327 security. But a move much above there, especially now that that's a reaction high, then you have a downtrend line right there. That would start to also, chip away at the bearish case. And what would really put the nail, not complete nail in the coffin, but close to it, would be that one. That's a big reaction high right there that came right after that divergent high. And then we would be within, spitting distance of the all-time highs, and they'd probably make a run at it. So those are your levels. And just to, reaffirm, that's my preferred scenario. So and we're probably getting to the point soon where we'll start to see what I call the point of recognition. The point of recognition is during a correction. If you're looking at it that way, it's where the bulls and longs realize that, hey, something's wrong here. This is not the usual buy the dip. I've been buying the dip. I keep buying the dip, but guess what happens? I'm going underwater. I got to pull the plug. This was our point of recognition. You get a big drop. So you had that initial kind of shot across the bow, couple counter trend rallies. The dip buyers were stepping in, and at this point they kind of realized something was wrong, and we had that big old drop into the lows there. And again, it wasn't even that big of a correction. It was only a 12%. Just barely met the minimum definition of a 10% drop to define a correction. So. I think we can get at least a move down to that level, which would be a little bit better, because that'd be we went a little higher this time around. So if we test that previous low, you're talking about a 13% correction, and from where we're at right now, again, if we get there, you're talking about another 7, almost 8% downside. And then to take a quick look at the S&P 500, the SPY on the 60-minute time frame, simple stuff. Look for these divergent highs, correction, divergent lows, rallies, most recent divergent high. And is that it for the correction off this pretty big divergence? And that's, again, I don't think so. It's certainly possible. This has been one of the most resilient uptrends now that we've been in from years. So we could shrug off these divergences. But again, I don't right now, and again, unless we take out these bounce target zones, I don't think so. So this is the one I laid out right here. When we gapped down below it, and we had several opportunities to short it on the back test. We had that leg down, we rallied back in, and that's the same. It's a gap resistance zone. This gap right here, big old gap. And there's also some resistance here about 416.68, and that's where we failed last week. So now we basically ran up in the bounce target zone, which is a resistance zone, and we're back below it. There's a gap down here. That would be the first target or support. If that's taken out, that should open the door for another move down. And then if we can get and stay below that 410.39, we already broke it once. We recovered it, and again, that wasn't ideal. That shows that the S&P 500 has been extremely resilient for months. If this market is going to go much lower, if those targets I just said on QQQ are going to get hit, you're going to need to see the S&P 500 break down. So far, it has been and continues to be primarily a correction in technology. And tech is the biggest sector of the S&P 500. And because of that, the S&P 500 has gone absolutely nowhere now for months. This is April, at least a month, I should say. That's 1 month, mid-April right there. In other words, we're trading right now where we are today, right here, where we were back in mid-April right there a month ago. So we went up a little, down a little, and this is because tech is putting pressure on the market while other things. The financials and industrials have been holding things up, and I've talked about those recently and keeping a very close eye on those. XLF financial ETF hit the other day, hit that trend line to the button right there. And I've said this is one, and I can tell you this with a strong degree of conviction, this sector is going to have to break to get a half decent correction in the market. And so far, it just pulled back to support. The buyers stepped in where they should have. Divergence building. I think it'll go. Oh, I know it'll go. It's just a matter of when's it going to go. How much higher? We can walk up this trend line for months, or we could break it tomorrow. And until unless we do, you can't, expect a much bigger drop, nor do you want to go crazy short because you have some key sectors such as this one above trend. So that's XLF, XLI, and again some others. XLI, you had a little whipsaw here. You had this trend line. This is how I drew my trend line here. I've had it drawn. It's a pretty good fit. A lot of reactions along the way, especially recently. And then the other day we had what looked like a bona fide sell signal, a solid breakdown, but look what they did. It was a whipsaw or a fake down, false breakdown. We whipped right back above it, and we're on that line now. So sometimes you get that, and then the real thing comes. Other times you get that, and that's quite bullish, and you get another rally, another leg up. So again, levels to watch. The trend line I think is still valid. There's enough reactions, and what we can do now here, let me see these candles that are a little bit below there. I'm going to pull that trend line now because we've had the whipsaw. I'm going to modify my trend line if I can grab it here. There. And now what I've done, and I'm going to pull it up here a little tighter to come to the bottom of that candle. Now here's a revamped trend line. Comes in at these lows right here. Back in early February, late January, you got one there. And then the other from the other day. So at this point in time, let me go ahead and set a trend line alert to get a heads up when this trend line gives way. Okay, so all of that stuff, at least what we started out with on those 60-minute charts, those are more of we'll call them micro levels, nearby levels that are likely to determine the next drop 2-3% or 2-3% rally like we had last week. Whereas bigger picture is this. This is the daily chart of SPY, the S&P 500. There's our primary uptrend line, a very, 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 very significant reaction low back in March of 2020. And so far, as mentioned, solid breakdown, big impulsive red candle, back test, and we're still back testing from below. I mentioned that the other day, last week, that when you back test, the tough part about it, sometimes you back test and you can back test for quite a while. Sometimes it's one and done back test. Sometimes you back test for days, even weeks. Usually not that long, but it can happen. And then sometimes you backtest and then you regain the trend line. So there are no guarantees, but what you want to look for is an impulsive rejection. So at this point, again, I think it'll be probably if we can reverse and take out Friday's lows right there on that candle, that green candle, that should do the trick. And especially if we can take out that previous low from last week, which is Wednesday. Oh yeah, we'll definitely be, that will be a clear rejection off the trend line. And that should open the door to a much larger drop. So that's what I'm looking at on the daily chart. QQQ on the daily chart, same thing, primary trend line off the lows, recently broken down, the lows of 2020 that is. Breakdown, back test so far, stopped, didn't even come back all the way for a back test. We made it about halfway and we're kind of stalling out. So we continue to see that underperformance weakness in QQQ, although as I said last week, once we break down in the financials and the industrials, I think they will outperform the S&P 500 or at least keep up with QQQ. Because remember, in the S&P you have defensive sectors, so it's rare to see the S&P 500 drop more than the Nasdaq 100. In the last bear market in '08, they kept pace, and that was because the financials melted down. The banks had their hand, they were caught with their hand in the cookie jar, cooking, doing all the shenanigans they were with credit swaps and CDOs and everything in the housing market, and so they took it on the chin, and that's why you had a roughly equal drop in the Nasdaq 100 and the S&P 500. And but again, because this is more tech heavy concentrated, no financials. I don't think there's any or hardly any utilities, things that are defensive sectors in there. You're lacking in QQQ. So you can certainly just stick with a QQQ short, and it may outperform the S&P 500. I just want to say when the dam breaks on the financials and industrials, we'll probably see a pretty good move down in the S&P 500. And then, of course, there's a small cap, so let's not forget about those. So the other end of the spectrum. And same thing, to reiterate and just recap, we broke down the primary trend lines last week. Hit this 211.75 support plus this little purple uptrend line there. Dual support, bounced and came in for a back test or near back test, and we're still below trend. So I make it very clear and simple, I have sell signals that are still in play on the more significant daily time frames, and so that formulates my longer term, my near to intermediate terms outlook. In other words, intermediate term, what does that mean? Near term is usually just hours to days, and then intermediate term is weeks to sometimes months. It all depends really on what security I'm looking at, what chart, what time frame. But right now we're talking intermediate term because we have these sell signals. So unless all these indexes can regain, meaning move back above these primary uptrend lines, these sell signals are intact, and they would indicate a much larger correction in the coming days to weeks to possibly even months. Hope that makes sense. Okay, and that's 21 minutes talking about the markets because that's very important. It goes into everything else. I'll get to all these other trades. I've shared long trade ideas lately, short trade ideas on individual stocks and sectors. And, it's a lot easier to swim with the tide than against the tide. So short trades are going to work better, individual stocks, that is, when the stock market's falling, and long trades will work better when the stock market's going up. It's that simple. It's not to say that a short trade can't work when the market's going up. There are always stocks that are falling when the market's going up and vice versa, but again, you just want to align your trades that way, and that's why I spend so much time here. In addition to the fact these are easy trade ideas too, and I even, I like to trade individual stocks, but I also like to trade the indexes because you don't, you're diversified and you can leverage up via futures, and they trade well off these levels. So I do that also for trade ideas, for those of you that want to be long or short the indexes at any given point in time. All right, let's talk about some other thing. Gold just continues to shine. Made my thoughts very clear on this, and it's been mostly a long-term. I've done a lot of long-term analysis and positioning on gold. Bullish since it bottomed back in early 2016, late 2015, getting bearish out of those positions to sidestep this what I still believe to be a bull market correction. Came back to my buy zone recently, hit the top of the buy zone there. Well, we hit it first right here. We had a little bounce, hit it again, fell to the bottom. And as I said, months before we even got there, the top was moderate support, the bottom solid support, and that's a kind of a load the boat, re-entry for long-term positions, at least for me. And as I said, until and unless I state otherwise, if I'm bullish on gold, I'm bullish on silver, I'm bullish on the gold mining stocks, silver mining stocks, and they all continue to do well. There is some resistance. You can see I have a line. I've had a line here on my chart for a while, about 174. We're a little bit above it now. But gold continues to shrug off divergences and everything else. And what I like recently that's helping to support the case for the bullish case for gold, in my opinion, is Bitcoin's finally, we got a sell signal a couple weeks back, I should say, on Bitcoin. And with a lot of hot air coming out of the cryptos recently. And one of the things I've stated, besides just everything I've talked about in the technical or charting case to be bullish on gold, I've talked about the fundamental case, whereas I've read article after article, people just dismiss gold as being an inflation hedge or a way to get out, protect yourself from falling dollar, things like that. And it seems that a lot of these crypto fans figure that gold is no longer useful for that purpose, that crypto is better. And so therefore, the fact that money's coming out of crypto lately, that should give a tailwind to gold. And so far it has. Lately gold's been moving up. So again, these are levels on the GLD chart. That's just the daily chart. Long term, this is the bull market in gold right here. This gold bottom back in late 2015. Consolidated for a while. To me, that was like the seal the deal level for that we're in a new bull market once we took out that 130 level. It was a very big level resistance. So gold based, even though bottom back here was basing, broke out, and this is just boom, 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 and it stopped there because that was a previous bull market high, major resistance, and again, case was made that we'd get a correction. And so far we've had that. So now what you want to watch is, as each of these previous reaction highs are taken out, it's going to increase the odds that we're going to take out that previous high, and then that will be a breakout. And let's see. Oh, GDX. Let's talk about the miners. And silver. Let's see. GDX. GDX looking good. Around the same time gold hit that buy zone. GDX also hit this major support level right here, 31, 33-ish right there. Hit it once, twice, just like gold. Those were the two double taps. Remember, GDX is going to mirror gold. It just moves up more in percentage terms when gold's rallying. And so you had those two buying ops right there to get back in if you exited some long-term positions back here and sidestepped this, what I believe to be bull market correction. And looking good so far. And most recently, I just want to do this update. We had a downtrend line right here, which was taken out here. So zoom in a little bit. You can see the downtrend line. Here's the reactions: 1, almost 2 there, 3, 4, and then a breakout and a back test, moving up. Taking out that 39 level right now. So if it can put that in the rearview mirror, whether we have a reaction or not first, and if we do, these are all levels you can pull back to and make an objective long entry or add on. 37.50-ish, there's 39-ish. Next target up there is about 43. It's not a hard target. You're getting close to the highs. Once gold and GDX get up here, they're probably just going to rip on through those previous highs, in my opinion. And gold futures, this is what I've been talking about. You continue to burn through in a strong uptrend. This is a trend line to watch. Certainly one I mentioned if we pull back to and that 18, 17-ish support. But you can see we've had these divergent highs recently, and they played out for corrections more in time, more so than in price. We've had divergence building here for a while, but we keep going up. Gold's been burning through. I'm having to keep move these lines. And again, that's indicative of a very strong trend when you just continue to burn through divergences. Trust me, we're seeing that for months on the stock market. It would burn through a lot of the divergences or have a correction, but it would be a very minor correction. So again, not a fan, and I've said that too. Some of the commodities are getting hot. Gold's not getting hot at all. Gold, like I said, lagged behind, and that's why I've been so bullish on it lately, because every other industrial metal, and gold it definitely has an industrial component to it. It's used in a lot of electronics. It's one of the best, conductors of electricity. You have copper ripping, lumber, everything else, and gold just was left behind on that run. And again, for reasons that I said, I think it was being dismissed or rejected as any useful value for a flight to safety or a way out of and around the dollar, like everybody was talking about with the cryptocurrencies. But again, gold, like I said, has been around for thousands of years, and has a proven track record where cryptos don't. And silver, this is a 60-minute chart like we were just looking at on gold, on the gold futures GC. This is SI silver futures. There's a comparable uptrend line. So it's probably the most important levels I can give you on silver right now, just like gold, is those uptrend lines on the 60-minute chart that comes off the late March lows right there. And again, divergence building. So do you want to be chasing it right now? No, again, I don't, I do this update to say, hey, it's in an uptrend. I wouldn't short it, but, I'd wait. I like to buy pullbacks to support or breakouts above resistance. And that's what silver looks like. It's in an uptrend. It's coming to these previous reaction highs. If it can take those out, that's going to be bullish. Let's just look at, I already covered GDX. SLV, by the way, is your silver ETF. And you can see kind of take a look at it this way. We have just multi-month consolidation here. This is when gold peaked out back in August or so, and this is the correction in silver. So just like gold, if it can get back above those previous highs, that should open the door for the next major leg up there. And as far as my long-term analysis goes, a big component of that, on gold and silver that is the dollar and the euro. This is the euro-US dollar pair. There was our primary bull market or bear market downtrend line. This was a bear market in the euro that was taken out recently. That was a bullish breakout and a back test, as mentioned. And so over time, I expect these targets to be hit. I see more upside in the euro, which means more downside in the dollar. Remember, this is just like it's the euro against the dollar, so it's looking at the dollar upside down. And from time to time, I like to do this. I know there's always new people coming on board, but I like to illustrate the relationship between the dollar and the euro. Remember, we're looking at the euro-US dollar pair, so it's almost an inverse chart of the dollar, and you can see clearly over time, there are periods of temporary disconnect, but for the most part, when the euro's rallying, meaning the dollar's falling, that's these green and red arrows, gold's going up. They correct, and there's usually correction. There was a peak right there. There was a correction in gold. It was a bigger drop in the euro-US dollar, but then they both rallied. They both corrected here. They both rallied here. Both corrected. You get the point. And remember, they're not going to. These charts won't overlay because they're not priced on the same scale. Gold's going to move up and down more in percentage terms. Currencies don't move up and down that much. But again, the relationship, the zigs and the zags on the major trends are unmistakable. This was about the only disconnect, or the biggest disconnect we've had in years. Other than that, the relationship, again, is very, very tight and consistent over time. And it's simple. A falling dollar, weaker dollar means it takes more dollars to buy an ounce of gold, so that is bullish for gold. So I remain longer term bearish on the dollar and therefore longer term bullish on gold. And quick update on the cryptos, Ethereum, really Musk, Elon Musk, and said it the other day, the guy's a brilliant engineer. Nobody's going to argue that, but I think he's a egomaniac. I think he comes out and tweets and takes these positions and pumps these cryptos just to see if he can move the market. You know what I suspect too? It hit me over the weekend. Is I'd have to look into it. I know this. He got in hot water, as you guys recall, a couple of years back for when he made that tweet about. With the company, with Tesla, and the SEC slapped him on the wrist. He got in hot water for that. Remember, Tesla is a regulated. It's a security. It's regulated by the SEC, and you have these cryptos are unregulated, or at least they're not to the extent of stocks. I don't know the exact thing. So, yeah, I think he's having a field day because he can get away with doing this. Pumping and dumping these cryptos. And I swear I think he does it just to see how much he can move them up and down. I mean, why not? What's the reversal in Bitcoin recently after being so bullish on it before? Same with Dogecoin. And anyway, so it kind of does matter because the crowd chasing these things, a lot of people buying them because people like Elon and I mean, who knows, the Kardashians and some of these obscure celebrities pumping these things, and they seem to move them. That's not solid fundamentals. But look, let's talk technicals. Right now, the cryptos are coming under pressure, but ETCG, Ethereum, which has been outperforming Bitcoin lately, is still at that trend line support. So you can make a case to step in once again. Every time it's hit this trend line, it's bounced. But a stop not too far below, especially these recent lows, that's not going to be pretty. Sooner or later, this crypto bubble will pop. You can't say at this point in time that's not anything more than a correction, just like this wasn't anything more than a correction before that next big leg up. But I just wanted to do an update there. We are back at support, so let's keep it very simple. And you can make an objective case to step in long again, once again, with a stop somewhat below. Targets, I don't even have any right now. That previous reaction high was certainly a target right there. But lately it's just been a matter of, you get 20-30% bounces on all these pullbacks to support lately. But do not get married to these cryptos because when the bubble finally breaks, and we've seen it before with Bitcoin, do not underestimate how much they can fall and how fast they can fall. So on that, GBTC is the ETF type instrument that tracks Bitcoin and Give you a sell signal back here with a first target zone right here. That was hit back then. We bounced on my first target zone for a while, but just the other day broke below it, and I said that gives the next sell signal, opens the door for move down to my next target, which was laid out at that time of about 28.16, and we're not even halfway there. So I think we're still headed down there at minimum in Bitcoin. And then somebody asked today or yesterday, Friday, in the comment section for an update on Riot. Riot, is one of my go-to Bitcoin proxies. What I mean by that, it's not Bitcoin. It's just a company, Riot Blockchain, that tends to move up and down with Bitcoin. And so Riot, just like Bitcoin, broke down recently. You had a breakdown above 38. And these were on the last couple charts that I've posted. It's been a while since I've updated. I've had these levels there, 27. That was hit last week. And we broke 27. We actually had a back test to it. Support once broken becomes resistance, and popped up on Friday to hit it, and we'll probably now head down to that 1784. That would be my next target, and if 1784 is taken out, 1165. Mara is one I started tracking recently, and I posted that as a short trade idea a few weeks back. Marathon Digital Holdings, another crypto or Bitcoin proxy, posted as a short here, and that's where we're at now. We're down about 53% from that first objective short entry, and we're coming back. And look, just on Friday, we bounced back. We hit that 2437 target here, broke it on last week, and then had a back test on Friday, and it's down another 9% since that back to actually a little bit more, about 10 or 12% since the back test on Friday. So next target 1615. That's still my next target, and then ultimately I think there's a good chance we come on down to that 1037 and primary uptrend line right there. Okay, got to feed the bulls too, and this is one I own. I like this little guy here. It's high risk, but DM Desktop Metals, a little divergent low. They're going to report. Gosh, either they reported this morning or today? I got a notification from my broker that they're last week that they're going to report. It was either today or tomorrow, and I don't know if it's before or after the bell. I'll have to look it up, but just keep that in mind. And this guy is it's aggressive stock. I'm going to just ride it through earnings. My position's small enough that it, anything less than a 30-40% gap isn't going to kill me, so I'm going to ride that one out. And next target remains here about 1566, and then potentially up there at about 2141 right there. So that is a long trade, and the basis for that was a break of the downtrend line, breakout back test plus 1079 price support plus uptrend line support, all came in together recently, and the divergent low, not to mention that positive divergence as well. So that's a long trade idea, and we still have some others. Let's see here. I'll mention an update on Hertz. Hertz HTZ GQ, Q meaning bankrupt, and or bankruptcy, under bankruptcy proceedings, I should say. And it's still flirting with that 640-ish, 650-ish resistance right there, and that's again that previous reaction high, and some other ones there. I still think it's gonna, if you gave it a little room, if you did short it there, I told you it's very aggressive trade, but probably going to come back in at minimum to this trend line right here. Peloton also mentioned as a short recently in recent videos. It was last sell signal triggered on break of under 98.68. Kick back, gave an objective short entry at that level on Friday. Make it almost a perfect back test of that level, moving lower today, and still most likely headed down to 72. What else do we have here? There's a bunch. Winnebago was laid out as a potential short, but it needs to take out, which it's about to do. That's why I'm trying to update the ones that are most timely. 73.60, starting to crack there. I have a target all the way target zone down here from about 60.90 to 58.70. So 60.90 would be my first. And it's a pretty aggressive target. There'll be a stop along the way right here at about 66. I probably should give you that now if you care to short this one. Yeah, definitely a stop along the way. or support, which will probably come into play around 66.58 plus the 200-day exponential moving average. So, and a sell signal now because we're cracked below there. So that's going to be a 7.5% drop to the first target. Probably get a bounce there. Depends what the market's doing at the time if we get there. And if we continue down to that 60-ish, 90-ish level, that's about a 15% drop. So there's another actionable trade idea for you. Tesla, just been persistently bearish on this one for a long time since this breakdown here, and still think we're going lower down to at least minimum 465-ish right there. In Tesla for the last few days has been flirting with the 200-day simple and exponential moving averages. Buyers could step in. If they do, any bounce back to 662 is an objective short entry, or if they solidly break and close below these 200-day moving averages, that should also open the door for another move down there. And last but not least, lumber continues to go. We had sell signals on that recently on the 60-minute chart with the break of the minor trend line. Then we took out that secondary trend line. Here, let me show it to you. Where'd it go? Right there. There was the first sell signal right here. Second sell signal just came. We broke the secondary, more important trend line there. And lumber has a history of big drops, these parabolic moves. Let me try to zoom in and I'll show you this. I'm going to have to move this over here so you can see it. 1 second here. Okay, I zoomed in nice and tight, and you can see this is the parabolic trend line right here. I talk about this is typical for lumber. It tends to go parabolic, and then it has these near vertical drops right after that. So this is our most recent parabola or parabolic trend line, and there was our sell signal back here, and it continues to fall. I think it's down 25% or so, and my minimum target is this uptrend line right here. To kind of zoom back out and show you just what lumber has done is right here. This was the pre-pandemic peak, and so lumber prices are up about 168, almost 170% since then, since the pre-pandemic. And if you look at the lows, they are up. There's a number of 500, about 540% off the lows right there. So a lot of hot air to come out of lumber, and the fact that if I'm correct on the stock market, when the stock market goes down, you're going to see some hot air come out of some of these commodities, I think. So for the time being, as I've said recently, I've cooled off a little bit on the commodity trade. I'm still longer term bullish, but being that they've been correlated with the stock market, if the stock market's going to drop another 5, 10+%, you're probably going to see the brakes come on, corrections, or at least a headwind for a lot of these commodities, including lumber. Alrighty, a long video. I wanted to cover a lot. Again, half the video was spent covering the equity markets. So let me wrap it up here, get it out to you guys, and if I see anything else, I'll follow up with some charts below this post in the comments section or under a new post. This has been Randy Finney with Right Side of the Chart. Have a great day.